Most traders are not losing because they're wrong. They're losing because they're chasing what looks big while ignoring what is truly asymmetric. They risk 10 to make 1, and then they wonder why time keeps emptying their account. But what if you reversed that thinking? What if your entire approach became this: risk $1 to make 10? Not as a slogan, not as a fantasy, as a discipline, as a filter, as a way of seeing opportunity that most people never develop. Ask yourself, when you place a trade, do you already know what must happen for you to be wrong? And more importantly, do you know what could happen if you are right? That question separates speculation from professional thinking, because the market does not reward activity, it rewards positioning. There is a difference. Many traders believe success comes from being right often. It feels logical. Win more than you lose, and you should come out ahead. But the market has a way of punishing obvious logic. A trader can be right 7 times out of 10 and still lose money if his losses are large and his wins are small. Another trader can be wrong most of the time and build real wealth if his losses are controlled and his winners are allowed room to grow. That sounds strange at first. It sounds backwards. But isn't that exactly why so few understand it? The game is not accuracy. The game is leverage over probability. If you risk 1 to make 10, you do not need perfection. You need selectivity. You need patience. You need the courage to wait while others feel the need to act. And waiting is harder than trading. Why? Because action feels productive. Sitting still feels like missing out. Watching price move without you creates tension. You begin thinking, maybe this is the move. Then you force a trade that offers little upside and large downside. You step into poor positioning. Your stop is wide because your entry is late. Your target is small because your confidence is weak. Now you're risking 5 to make 2 and calling it opportunity. But it was never opportunity. It was impatience wearing the clothes of conviction. Do you see the difference? A true 1 to 10 setup rarely looks exciting at first. In fact, it often looks uncomfortable. It forms quietly. It builds in places where the crowd has lost interest or where emotion has reached an extreme. Price compresses. Volume changes character. A level holds repeatedly. Weak hands get shaken out. Then pressure builds. Something is changing beneath the surface. But here is the question: can you recognize behavior before movement becomes obvious? That is what you must train your eye to see. Look for points where risk is clear and small. That matters first. Not potential reward. Risk. Can you define your exit precisely? Can price prove you wrong quickly? Is there a logical line in the sand where your idea is invalidated? If not, there is no trade. Most people ask, how much can I make? Professionals ask, how little must I risk to find out if I'm right? That shift changes everything. Because once risk becomes small and defined, large opportunity becomes meaningful. Now you can hold through noise. Now you can let a position expand. Now you can withstand being wrong several times because each attempt costs little. And when one move unfolds fully, it pays for many small mistakes and more, because creates effect. Small defined risk creates emotional stability. Emotional stability creates patience. Patience creates better selection. Better selection creates asymmetry. Asymmetry creates long-term edge. Notice how it all begins with risk, not reward. And yet most traders think in reverse. They dream first. They protect later. That is why they lose. Let me ask you something. Have you ever taken profit too early, only to watch price continue much farther without you? Of course you have. Why does that happen? Because deep down you were focused on avoiding loss, not capturing opportunity. The moment profit appeared, fear entered your mind. Fear whispered, take it before it disappears. So you closed the trade, not because the market told you to, but because your emotions did. That is expensive behavior. If you want 10 for 1, you must think differently once you're in the trade. Entry requires precision. Holding requires understanding. Big moves do not travel in straight lines. They breathe, they pull back, they test conviction. They create doubt. If every pullback shakes you out, you will never catch expansion. And without expansion, there is no asymmetry. But here's what most miss: conviction should not come from hope. It should come from evidence. What is price structure showing you? Are dips shallow or aggressive? Is volume confirming continuation? Are breakouts holding instead of failing? Is weakness being bought quickly? These are clues. Quiet clues. The market speaks softly before it moves loudly. Listen carefully. Also understand what to avoid. Avoid crowded entries where everyone sees the same breakout after price already ran hard. Avoid trades where your stop must be wide just to survive normal volatility. Avoid setups built on excitement instead of structure. Avoid revenge trading after losses. That state of mind destroys judgment because now you're not reading the market. You are arguing with it. The market cannot be argued with. Only observed. Only interpreted. Only respected. And respect in trading means accepting small losses without emotional drama. Can you lose $1 calmly? Because if you cannot lose one calmly, you will never make 10 consistently. That is the paradox. The trader who accepts small loss gains freedom. Freedom to think clearly. Freedom to re-enter when conditions improve. Freedom to wait. Freedom to hold winners without desperate attachment. Meanwhile, the trader who fears loss clings to bad trades, cuts good ones short, and slowly builds a habit of mediocrity. One becomes strategic. The other becomes reactive. Which one are you becoming every day? Every chart is teaching you something. If you stop looking only for entry signals and start studying behavior, watch failed breakdowns. Watch trapped buyers. Watch quiet consolidations after strong trends. Watch how price behaves around important levels. Not just where it goes, but how it moves there. Speed matters. Hesitation matters. Rejection matters. Compression matters. Most traders think big losses come from one bad trade. They don't. They come from a habit, risking too much for too little. That is where accounts quietly bleed. A trader sees a setup, feels conviction, enters heavy, and places a wide stop because he wants to give the trade room. But what is he really doing? He is exposing serious capital for a modest reward, often chasing 2 points while risking 5. That is not strategy. That is imbalance. Now consider the opposite. What happens when your downside is small, but your upside has room to expand? Your entire mindset changes. You become sharper with entry. You become selective. You stop needing every trade. You begin waiting for moments where the market offers clear structure, where your loss is defined, tight, and acceptable, while the potential move ahead is much larger than what you are putting at risk. That is small risk with large consequence. And consequence works both ways. A small, controlled loss has little impact on your capital, but it has a powerful effect on your discipline. It teaches restraint. It keeps emotion stable. It allows repeated attempts without damage. One loss becomes information, not injury. But a large win born from small exposure creates a different consequence. It changes your equity curve in meaningful ways. One well-positioned trade can erase several small losses and still move you forward. Not because you traded more, but because you positioned better. Do you see the shift? The goal is not to avoid losing. The goal is to lose cheaply and win significantly. That sounds simple, yet very few trade that way because small risk requires patience, and patience is uncomfortable. Traders want movement now, they want certainty now, they want reward now. So they enter too early, too late, or without structure. Then risk grows because timing was poor. Timing and risk are deeply connected. When entry is precise, risk naturally shrinks. A trade near support, near breakout compression, near a clear invalidation point. These give you tight control. If wrong, you're out quickly with little damage. If right, price often has open space to run. That is where consequence becomes powerful. A $1 risk can create $10 not because of luck, but because the setup was built on imbalance. Limited downside, meaningful upside, favorable structure, and disciplined execution. Notice something important: small risk does not mean small thinking. It means intelligent exposure. You are not trading scared, you are trading clear. There is a difference. Fear avoids risk entirely. Clarity chooses risk carefully, and careful risk compounds. Imagine taking 10 trades. 7 fail, each costing 1 unit. You lose 7. 3 work and each returns 10. You make 30. Net result 23 units gained, even with more losses than wins. This is why professionals think in payoff, not pride. They do not need to be right often. They need to be right when opportunity is asymmetric. That is a very different game, so what should you look for? Look for trades where your stop is obvious and close, but your target is uncertain because it may extend far beyond expectation. Look for moments when crowd emotion is high, but structure remains calm. Look for compression before expansion, weakness that fails to break lower, strength that holds after testing. Most importantly, ask one question before every trade. If I am wrong, how little will it cost me? And if I am right, how far can this really go? Most traders focus on where price might go. Very few focus on where they should enter. That mistake changes everything. A good idea can become a bad trade simply because execution lacked precision. The direction may be right, the analysis may be sound, the setup may even unfold exactly as expected, but if the entry is careless, risk expands, emotion rises, and control disappears. Now the trade becomes heavy, uncomfortable, and difficult to manage. That is why precision must come before position. Ask yourself, how often have you entered because price was moving fast, only to watch it reverse the moment you got in? How often have you chased momentum, not because structure confirmed it, but because emotion pushed you? The market has a way of punishing rushed decisions. It rewards patience more often than urgency. Precision is not about catching the exact bottom or top. It is about entering where your idea can be tested cheaply. That is the difference. A precise entry gives you a clear line in the sand. It defines where you are wrong. It keeps your stop tight, your exposure controlled, and your thinking calm. But when entry is sloppy, that line becomes wide and uncertain. Now you are risking too much simply to stay in the trade. Hope begins replacing logic, and hope is expensive. Watch how experienced traders behave. They do not jump at every move. They observe how price behaves around key levels. They wait for confirmation in behavior, rejection, compression, failed breakdowns, quiet strength, trapped momentum. They look for moments where risk becomes small because location becomes clear. Location matters more than excitement. A breakout after a long build-up near resistance may offer precision. A pullback into strong support with clear rejection may offer precision. A false move that traps the crowd may offer precision. But entering in the middle of noise far from structure gives you nothing except uncertainty. Would you rather be early with a plan or late with emotion? That question defines trading character. Precision also changes psychology. When your entry is sharp, you feel less pressure. You are not instantly fighting drawdown. You are not staring at every tick in fear. You can think clearly because your trade began from strength, not impulse. This calmness allows better decisions after entry, and better decisions often matter as much as the setup itself. Cause creates effect. Better timing creates smaller risk. Smaller risk creates emotional stability. Emotional stability creates patience. Patience allows strong positions to grow. This is how intelligent trading builds. Most losses are not created by bad markets. They are created by poor positioning, entries made too high, too low, too late, too rushed, too emotional. Traders spend years searching for perfect setups while ignoring imperfect execution. But execution is where money is won or lost. Wait for your price. Let the market come to you. Enter where your idea is strongest and your risk is smallest. That is where real position begins. Most traders do not lose because opportunity is rare. They lose because they treat every movement like opportunity. That confusion is costly. The market is always moving, always creating noise, always tempting action. A candle breaks high, volume rises, momentum appears, and suddenly traders feel they must act. But movement alone means very little. Not every move deserves capital. Not every setup deserves attention. The market offers endless motion, but true asymmetry is uncommon. That is why you must wait for it. Ask yourself, are you trading because conditions are favorable, or because silence feels uncomfortable? Many traders cannot sit still. They mistake activity for progress. They feel unproductive when they are waiting, so they force trades with average structure, average reward, and unnecessary risk. Over time, average decisions create average outcomes, sometimes worse. Asymmetry is different. It is when the trade offers little downside and meaningful upside. It is when your risk is clearly defined, but the market has room to move much farther than most expect. It is not built on excitement. It is built on imbalance between what you can lose and what you can gain. That imbalance is where edge lies. But here is what makes it difficult. Asymmetric setups often require patience before they become obvious. Price may move sideways for days. It may tighten into quiet compression. It may test a level repeatedly without breaking. It may look boring while traders chase faster moves elsewhere. Yet beneath that quiet behavior, pressure is building. Can you recognize stillness before expansion? That skill changes everything. Watch for clean structure. Watch for levels that hold despite repeated attacks. Watch for failed breakdowns where sellers cannot push lower. Watch for strong trends that pull back lightly instead of collapsing. Watch for moments when emotion in the crowd is loud, but price behavior remains controlled. These are clues. The best trades rarely shout first. They build quietly, then move decisively. Waiting for asymmetry also protects your capital. If you only act when reward clearly outweighs risk, bad trades naturally disappear. You become selective, and selectivity is power. A trader who waits for strong imbalance may trade less, but often performs better because every position carries purpose. Less action. Better action, that is a powerful difference. There is also a psychological edge in waiting. When you know exactly what you are waiting for, noise loses control over you. Random movement no longer creates urgency. Headlines no longer pull your attention. You stop reacting to every fluctuation because your standard has become higher. Patience becomes a weapon, and patience is not passive. It is active observation. It is studying behavior without emotional interference. It is letting weak setups pass so stronger ones stand out clearly. It is resisting the constant pull to participate simply because price is moving. Most traders cannot do this. They chase movement. Professionals wait for imbalance. Most traders think clarity comes after profit. In reality, clarity begins the moment loss is defined. That is where calm thinking starts. Uncertainty creates emotional noise. When a trader enters without knowing exactly where he is wrong, every tick becomes stressful. A small pullback feels dangerous. A pause in momentum creates doubt. A normal fluctuation suddenly feels like failure. Why? Because there is no clear boundary between being early, being wrong, or simply being impatient. Everything becomes confusion. Now ask yourself, how can you trade confidently if your risk is vague? How can you hold conviction if your downside has no clear limit? You cannot. Without defined loss, the mind becomes reactive. Fear grows because uncertainty grows, and uncertainty clouds judgment faster than any market move. Defined loss changes that. The moment you know where your trade idea fails, your thinking sharpens. You stop guessing. You stop bargaining with price. You stop moving stops wider just to avoid accepting a mistake. Instead, you operate with structure. If price crosses your line, you exit. No drama, no negotiation. Just discipline. That creates something powerful, clarity. And clarity is more valuable than confidence. Confidence can be false. It can come from ego, from a winning streak, from excitement, from belief without evidence. Clarity is different. Clarity is built on knowing exactly what you are doing, why you are doing it, and what invalidates your idea. It removes emotional fog and replaces it with decision, making that is clean and deliberate. This has a deeper effect than most realize. When loss is defined, fear shrinks. When fear shrinks, patience grows. When patience grows, execution improves. You stop forcing exits. You stop chasing random entries. You begin seeing the market more objectively because your mind is no longer trapped in defensive thinking. Cause creates effect. Defined loss creates emotional stability. Emotional stability creates sharper observation. Sharper observation creates better positioning. That is how real edge is built. There is another side to this that traders often miss. Defined loss does not only protect capital, it protects mental energy. Every bad trade that lingers drains focus. Every oversized loss leaves emotional residue. Every unclear position occupies space in the mind. Soon the trader is exhausted, not because the market was difficult, but because uncertainty became heavy. A clean loss is light. You accept it, learn from it, and move on. A vague loss becomes baggage. That baggage changes behavior. It creates hesitation on the next trade, revenge on the one after that, and confusion in every decision that follows. Would you rather carry emotional weight or trade with a clear mind? The answer should shape every entry you take. Before entering, know exactly where your idea breaks, not where pain becomes uncomfortable, where logic becomes invalid. That line must be clear, deliberate, and respected. Once that boundary is set, the market becomes easier to read because you are no longer trading from uncertainty. Small defined loss creates clean thinking. Clean thinking creates freedom. Most traders work too hard for too little because they expect every trade to carry the weight of success. That is exhausting. They enter, take quick profit, reset, search for the next setup, repeat the process, and call it consistency. But what are they really doing? They are constantly harvesting small gains while never allowing meaningful opportunity to develop. They keep feeding on crumbs while avoiding the larger meal the market occasionally offers. This is where many stay trapped. Ask yourself, how often have you closed a trade the moment it showed profit, only to watch price continue far beyond your exit? Not a little further. Much further. Far enough that one held position could have outperformed weeks of small trades. That happens more often than most realize, and it reveals a deeper problem. The trader is managing fear, not opportunity. Quick profit feels safe because it removes uncertainty. It gives relief. It creates the illusion of control. But relief is not the same as skill. If every winner is cut short while losses remain full-sized, the math quietly turns against you. You may win often, but your account barely grows because your winners are never allowed to do real work. That is the hidden cost of impatience. Big progress in trading rarely comes from many average trades. It often comes from a few exceptional ones. Positions entered well, managed wisely, and held long enough for expansion to unfold. These are the trades that move your equity meaningfully. These are the trades that repay small losses, justify patience, and create true asymmetry. But only if you let them breathe. That is difficult because strong trades do not move in straight lines. They pause, they pull back, they test conviction. They create moments that look weak before becoming stronger. If every pause makes you nervous, you will keep exiting before the real move begins. Can you stay calm while a good trade behaves normally? That question matters. Holding winners is not passive hope. It is active observation. You must read behavior. Is structure still intact? Are pullbacks shallow? Is momentum healthy? Are key levels holding? Is weakness being bought quickly? These signs tell you whether the trade remains alive, even if price is temporarily quiet. This is where professionals separate themselves. They do not judge a trade by temporary fluctuation. They judge it by behavior that keeps them in positions longer, and time inside strong positions creates possibility. A move that first returns 2 can become 5. 5 can become 10. 10 can become something larger if market conditions support it. But none of that happens if fear closes the trade at the first sign of profit. Small exits create small outcomes. Let your best trades carry the load. Let strong positions earn what weak trades cannot. Accept that many attempts may fail, but one properly held winner can change the month, sometimes more. That is where real progress hides, in the trade you almost closed too early. Most traders think edge is found in strategy, a better indicator, a sharper pattern, a faster signal, but many overlook something quieter and far more powerful. Patience, not passive waiting, not hesitation, not fear of acting, real patience, the discipline to wait until conditions deserve your capital. That is an edge because very few have it. Ask yourself, how many trades have you taken simply because you were tired of waiting? Price was moving, screens were active, something looked close enough, and you convinced yourself it was good enough. Not ideal, just acceptable. That is how capital gets spent on mediocre opportunities, and mediocre opportunities produce mediocre results. The market constantly invites impulsive behavior. It creates urgency where none exists. A sudden breakout feels like a missed chance. A fast drop feels like immediate opportunity. Noise starts looking important when you stare long enough. Traders begin reacting to motion instead of responding to quality. Patience breaks that cycle. A patient trader does not trade because price is moving. He trades because structure, timing, and risk align. He knows that every position carries cost. Not just financial cost, but emotional cost, mental focus, and opportunity cost. Capital tied in weak setups cannot be deployed into strong ones. That matters more than most realize. Every unnecessary trade steals attention from the trade that may truly matter. That is cause and effect. Impatience creates overtrading. Overtrading creates fatigue. Fatigue weakens judgment. Weak judgment creates poor entries. Poor entries increase risk. Risk increases emotion. Emotion clouds decision-making. A simple lack of patience can quietly poison everything. Now consider the opposite. Patience creates selectivity. Selectivity improves quality. Quality improves positioning. Better positioning creates confidence built on structure, not emotion. That confidence allows calm execution and clearer thinking. One habit changes the entire chain. There is another truth traders resist. Waiting often feels uncomfortable because it forces you to sit with uncertainty. You may watch a setup develop for days and do nothing. You may let 10 average trades pass. You may feel like others are making money while you stand still. But standing still is sometimes the strongest move. Would you rather be active or be effective? There is a difference. Professional trading is not built on constant action. It is built on disciplined inaction until opportunity becomes clear. The trader who can wait without emotional pressure sees what impatient traders miss. Clean levels, stronger setups, better timing, tighter risk, and clearer reward. He enters less, but often earns more. Patience also sharpens observation. When you stop forcing trades, you begin studying behavior. You notice how price reacts at key areas. You see false moves. You recognize trapped buyers and exhausted sellers. You start reading the market instead of interrupting it with unnecessary positions. That understanding compounds, because the more patiently you observe, the more precisely you act, and precise action, taken at the right moment, often outweighs 100 restless decisions made from boredom, urgency, or the quiet discomfort of doing nothing while waiting for the market to finally reveal where real opportunity begins to take shape. Patience pays before the trade begins. Most traders think about reward first. That is where their judgment starts to bend. They see profit before they see danger. They imagine what they can make before asking what they can lose. The mind rushes toward possibility, big targets, fast moves, easy money, and in that excitement, risk becomes an afterthought. Stops are placed casually. Position size becomes emotional. Trade quality becomes secondary to profit fantasy. That is how bad decisions quietly begin. Ask yourself, before entering a trade, what is the first thing your mind measures? Is it upside or downside? Do you calculate how far price might run, or do you define where your idea becomes invalid? Your answer reveals whether you are thinking like a participant or like a professional. Professionals think risk first, not because they fear the market, but because they respect uncertainty. No setup is guaranteed. No pattern is certain. No amount of conviction changes the fact that the market can do what it wants, when it wants. Once you understand that deeply, your first instinct changes. You stop asking, how much can I make? You begin asking, how much am I willing to lose to test this idea? That question creates discipline. When risk comes first, everything becomes clearer. Position size becomes logical, not emotional. Entries become selective because loose setups no longer make sense. Stops become intentional because they are based on structure, not comfort. Suddenly, your entire process becomes cleaner because the foundation is built on protection before pursuit. Because creates effect. Defined risk creates calm execution. Calm execution creates better decisions. Better decisions improve consistency. Consistency creates long-term growth. This is how strong trading is built, not by chasing reward, but by controlling exposure. There is also a psychological shift that happens when risk becomes your first lens. You stop feeling desperate. You stop needing every trade to work. You stop attaching your identity to outcomes because each trade is simply a measured business decision, not a personal bet on your intelligence. That freedom matters. A trader obsessed with reward becomes emotional quickly. He holds losers because he still sees imagined profit ahead. He adds size because he wants larger returns. He ignores warning signs because greed narrows perception. Soon he is no longer trading structure, he is trading desire. Desire is dangerous in markets. Would you trust a pilot who focused only on speed and ignored fuel, weather, and control systems? Of course not. Yet traders do the equivalent every day. They focus on destination while neglecting the risks that determine whether they arrive at all. Protection comes first, then opportunity. That order matters. When you protect capital, you protect future opportunity. A preserved account can always trade tomorrow. A damaged account trades from weakness. Financial weakness, emotional weakness, mental weakness. Recovery becomes harder because pressure increases, and pressure creates mistakes. This is why disciplined traders survive long enough to thrive. They understand a simple truth. Reward is meaningless if risk is reckless. Control the downside first, then let the upside reveal itself.